I think 100% now, like the thing that next blows up crypto in a big way is these accumulators. Like there's no doubt. Fuck AI bots. Like no, it's these guys. They will become so popular and so over leveraged that like someone is going to take it too far.
Assuming that is true, it might actually be worse than the Three Arrows thing. Not just on scale, on spread. The companies that were lending to Three Arrows Capital were by and large crypto lenders. So it was kind of like crypto contagion. I think that most of the people buying the debt instruments for companies like MicroStrategy are not debt, not crypto companies. So this blows up, it is going to blow up whatever TradFi businesses are giving them money.
Yeah,
nice. Which makes sense. We've kind of reached
crypto is now a systemic risk to the traditional finance. And we're back. The Spelunking podcast episode. Is it episode 43? I think it's episode 43.
It is episode 43, even though the royal we hadn't even downloaded the previous episode to our load until like 10 minutes ago.
Yeah. I was traveling. We do want to say hello to Stanley Druckenmiller, who's obviously one of our biggest fans and listens to every episode of the podcast. So, if you want your Stanley Druckenmiller level alpha, this is where
you really also gotta stop from running our other listeners, Stanley. I mean, that thing's not cool, man.
Also, none of this is investment advice, of course. Well, there's stuff going on. Before you joined me, Ricardo was just saying that it's an interesting moment because like the markets are super up, but then there's like not a lot of noise. And I mean, my comment was that, well, Bitcoin is up. Everything else is not that up. But do you have a sense of like...
Okay, which is fair, but for what it's worth, Bitcoin is not, Solana is not like an all-time high, but it did bounce like 67% from where it bottomed after the last crash, which is a non-insignificant increase. And still, where it says that, usually when Bitcoin reaches all-time high, you have people coming out of the woodwork and jumping on it and sending you DMs. So like, man, I'm finally getting to this Bitcoin thing. And nobody seems to be doing that right now, which I found interesting.
Yeah. Do you have a sense of like why kind of like I feel like in this cycle, we just in general haven't really gotten like a mania thing at all, right? Like it's sort of this relatively steady climb. We hit all-time highs, 3 trillion market cap, and then like no taxi drivers are talking about their investments in VeChain or XRP.
We've talked about this before about like market structure things. So funding rates have been low, except for the first kind of 100K break. After that, there was some like open interest increases and stuff like that. But otherwise, the market looks pretty chill. And it's quite clear now that we'll maybe get to this later, but the first signs of how we're going to build a market exuberance is here with these kind of treasury plays increasing. And that is the kind of starting pistol, I think, that we're observing in the market that will eventually become quite big and create something of a real bubble besides it. But how we get retail here again is a good question. Like, I don't know. And it seems people have been burnt by the industry so much or the mainstream has heard about it enough that it's difficult to get excited. So it's hard to tell what's, again, that thing that gets kind of people excited. But apparently we don't need that. Apparently we're totally fine.
Yeah, I mean, a friend of mine texted me like the Bitcoin price and was like, who's like, this is not a crypto person, like, who's buying at these prices? I was like, and my answer was just institutions. Like that's kind of what it is, right? Like everyone is hedging global volatility.
Yesterday in particular was interesting, where the bond market was down and the stock market was down a lot, and BTC was up, which was kind of very, very Oh yeah, the thesis is happening kind of feel to it.
Yeah.
Also, something that I was studying Temo earlier, which this is completely, again, don't listen to us for any investment advice. This is completely harebrained hypothesis based on our own biases. But something interesting to check is that yes, Bitcoin has breached all-time highs, but did so only in dollars. In euros, it's still about a good 7-8% from ATH. So I wonder how much of this is not the Bitcoin price going up, but the dollar price falling. And the reason why stocks would fall as well is just simply lack of confidence in the US market, generally speaking.
Don't you know that all fiat is going to zero?
I know, man. I've been waiting for that
You shouldn't
for
be
like
measuring the Bitcoin price in fiat. It's the other way
indeed
around.
one Bitcoin is one Bitcoin, man. We all know that. It is the mantra of the podcast, right? It's what it says on the tagline right there.
Have you been on that thesis since 1978 or so? I guess.
I've been on the thesis since like what was it, like 1913 or thereabouts. I've been around this thing for much longer than I look, man. It's like I have really good skin care. That's it.
Yeah. Well, anyway,
I don't want to take this on a tangent, but we could discuss that more, the skincare routine. But maybe that's not the podcast.
It's remember to wear sunscreen and moisturize.
And
Anyway.
also stay indoors. It helps a lot.
Oh, that's true. Just stay like staring at Trading View inside, preferably all day.
Indeed, man. I said it before. I'm actually Latino. I just happen to spend all my time indoors.
But maybe we should discuss the those so that like maybe on the topic of just like news. I think the only really interesting news that came out was that Circle is thinking about selling to Ripple or Coinbase, and I mean the thought of Circle being sold to Ripple is just one of like the most hilarious things I can imagine.
Yeah.
I'm fairly skeptical of that actually ever occurring, given the deal that's in place with Coinbase. Like Circle is basically not a profitable company, and it's very difficult to make it profitable because of the deal that's in place with Coinbase. It could be that Ripple is there just as like a pricer. Like if I was Circle, right, I wouldn't want to just go like to Coinbase and be like, what are you guys going to pay? And Coinbase is like, well, what if, we don't pay and you just hand the shares over? Like, so having like someone external price it might just be like a strategic move to price the M&A. But I don't know. What do you guys think of that? Is it? Yeah,
It was interesting that a few years ago I heard this thing of how to describe to a non-crypto person, like what sort of yardstick to give them about if a chain is legit or not, right? Not if it's a good investment or not, but if it's a legit chain or not when it comes to governance, is check if USDC is available. Because Circle is going to basically do a lot of due diligence to make sure that they only get into chains that have good governance. And it's also because they don't want to get burned. And it's also kind of like an indicator of actual activity on a chain. And the tricky chains that they mentioned, that this person, who I don't recall who it was, mentioned that that had like high market cap, but USDC was not available, were basically Tron, Cardano, and Ripple. So I wondered if up to a point, this is very much of a crypto insider view, but up to a point, I wondered if for Ripple, this is almost a move for legitimacy kind of thing. I mean, Ripple's whole thing when they were born was in theory cross-border, like easy, cheap cross-border transfers, which is what USDC whole thing has been. So maybe they see this as, Ripple, but actually not sketchy kind of thing.
Well, I mean, there's also like the Tether guys are doing a chain. Like a lot of people are trying to unseat Tron from the position of being kind of like the primary stablecoin thing. So I mean, but like, I'm not sure if this legitimizes Ripple as like, because they could just like strike a deal with Circle, right, and get USDC on it. Like, it's not that big of a deal. I think it's more like just like a play to position and like get like a semi-leading position in the market that they were originally going after, but yeah, kind of like acquiesced
Yeah.
or gave up.
Mika?
Where to take this? A couple of different riffs that one could have. Let's go with the basic one, which is I just hope Ripple doesn't buy them, which I think is a sentiment shared by you guys
Why?
and the market in general.
Why?
I just don't want Ripple to buy them. Like, it's Coinbase. It's Coinbase's thing to acquire. We've known this for like 7 years already. It's time for them to get it. I think it's more beneficial to the ecosystem that Coinbase has it.
I'm extremely biased because I'm a shareholder in Paxos, but I mean, I would love if Ripple bought USDC. Just clear the air.
Obvious conflict aside.
Tether pulls back from all the markets that are regulated, which is increasingly like trending towards 100%. And simultaneously Ripple buys USDC so that it goes to fucking zero. Like, that's I cannot think of a better, trajectory for my shares.
For anybody who didn't parse that, what he said is he would love the destructive effects or that it will have on USDC of Ripple buying Circle.
Yeah, the actual downside, which like that was sort of semi a joke. I do think like it would be good to like unseat Tether and USDC a little bit to get more players in the market, and I think that's going to happen to some degree because there's so many big institutions coming in with stablecoin offerings. Like, literally on a weekly basis, I hear about new banks, like literally top 5 banks that are going to do their own stablecoins and stuff like that. So I think that competition is coming, but I think the problem with Ripple buying USDC is that I think the actual practical effect is that all of that is just handed over to Tether, which doesn't work in practice because Tether is not operating in a lot of markets. But I think like the people holding those assets will have to figure out ways of using Tether, and that's kind of unfortunate because like, yeah, it's like not only is it more cumbersome to use Tether because Tether is not available, like for example in Europe at all, and I'm not sure if it's available much in the US either anymore. But like you also just don't kind of like want to, I think, prop up Tether unnecessarily. Like, you want to create space for new entrants.
Maybe I'm being kind of stupid here. It's the kind of same reason why collateral-based Ethereum in trading pools hasn't replaced Ethereum. But isn't this supposed to be an efficient market where like you have the yield-bearing versions of it running as the main collateral type on exchange, and you're making money off of that while you're so if you're like market making and you make 8% per year on that, you make 5% more on your underlying collateral having like some structured product / treasury bond yield / whatever lending structure behind it. And I'm kind of surprised that the market just doesn't push that way. Like, crypto is like inefficient in so many ways, and it's then efficient in some ways. And I'm surprised that it isn't efficient in this way, actually. I just would have thought.
Well, yeah, well, there's a couple things there. So I think every stablecoin issuer would love to have a yield-bearing stablecoin like that will produce yield for the end user. Like, that would be the most popular one. However, in most of the big markets, that's actually not allowed. Like, that's flat out not allowed in Europe. Fairly sure that's not allowed in the US. So what happens instead, like you still, like, people still need stable coins, and so they have their like market share. But what happens instead is that the distributors of those stable coins, not the issuer, the distributor, basically the exchanges, are getting a portion of the yield. That's the deal that Coinbase has with Circle. That's basically the deal that every exchange has with the stable coins they support. And so like, it's not efficient in the sense of like the end user, but I think that's primarily a regulatory hurdle, because like, you know, if you could just hold USDC and earn whatever, like 3-4% a year, like that would be the most popular product in the world, like 100%. And I think people like are very aware of that, and a lot of these companies would do that if they could.
Yeah, like Athena, I mean, essentially offers that. So, I mean, it's a structured product and then a stable coin, but like,
Yeah,
you know, with some time going forward, those are so meaningful amounts as well. They're like very, very meaningful to have as end user yield, and having them pass through end users through this intermediation, like it makes sense. Like I'd be surprised sitting here 10 years from now having the same discussion and wondering still why it hasn't happened.
I mean, I think it's a UX, like the UX benefit is just massive. Like you know, in the US you can obviously buy like T-bills and hold them and so on, but like to wrap it kind of in the same product that you're actively using for payments, like that's just like incredible UX that I don't think the traditional markets, like they could replicate it maybe, but in practice they won't be able
Absolutely not. This is not doable on normal.
And then when you compare it to like bank interest rates, they're like garbage. And so like it's just so efficient. Like like if you can just in an automated way distribute the yield to all holders into whatever wallets, whatever country, like, you know, like it's just so efficient. It's beautiful, but I don't think it's going to happen. And I think the reason is actually that the banks don't want competition, right? And they've got quite a lot of regulatory capture.
Yeah, I was going to say
there does remain a question of whether a bank could maybe do it. I'm not sure. Like if you are actually licensed as a bank in some jurisdictions, like maybe you could do something like that. I don't know.
And something I want to say this is kind of like a little bit of a conversation rollback, but you said like there are a lot of banks and institutions wanting to jump on that. It's not just institutions that are currently financial institutions that were looking to jump on that. I mean, I'm going to keep this vague, but it must have been even 4 or 5 months ago that I heard from at least one large European telephone carrier by large, I mean with a global presence and massive like valuation, that was very much looking into getting into rolling out their own stable coin precisely to do easy, cheap cross-border transfers, which makes all the sense, right? They already own the customer relationship. They could do this relatively transparent, and they also get to benefit from holding the assets, the underlying asset themselves, and keeping the yield themselves. So there's also a little bit of perverse incentives of why this businesses may not want to do the yield-bearing version that quickly. While the regulation, I'm sure, also slowing them down.
Can I touch on one point there? So I think there's actually an interesting dynamic there, which I think this relates to. I think we discussed this in one episode, like the PayPal USD. Like there's a really interesting moment in time now where, like, you know, corporations can become asset issuers, right? Like, and that's like a dramatic shift from how things have been for the last many hundred years. So in the case that you're describing, the company that's doing all these cross-border payments and potentially payments with partners and so on, like if you can force them onto your payment asset, you're suddenly getting like the full yield of like many other organizations assets, even though those organizations aren't really giving anything up. It's just like a structural question, right? Like if I'm a company, I've got like bills to pay and so on, I'm probably not holding these my fiat in like long-term interest-bearing accounts or like with the central bank or like whatever. But in this case, you kind of get that. Like, so for me, there's no real difference, right? Like I'm using regular euros, or I'm using like my partner's own euro. It kind of doesn't matter. But suddenly the yield generation isn't going to the bank, it's going to the company. And that's kind of insane. Like, I think that structurally changes a lot of things. You can imagine like Apple and their whole like supply chain infrastructure.
Oh yeah.
Like if they just force all of them onto Apple USD, what the impact of that is, because they suddenly become like globally one of the largest kind of bank type things ever. Also, they have Apple Pay if they just funnel everything through their own, like there's so much capital in that system that's kind of like just sitting on a number of different bank accounts, that if you can pool it all, collect yield on it in like a simple centralized way, it's incredibly, like, it unlocks a huge amount of value for the company. What it doesn't do is unlock a huge amount of value for the banks. It's in fact extremely extractive of the bank's business model. So yeah, I think it's fascinating. Like that like, do you guys remember a project called Sweet Bridge back in the day?
No, but that's not even what I was thinking. Keep going.
So Sweet Bridge was like this like 2018 supply chain thingy, like very like far out, kind of like we're gonna have this like system that basically like allows all the participants in the supply chain to like unlock their inventory and like sell that up front or get debt against inventory, like just basically speed up the process of bills being paid and inventory moving around the supply chain. And they had a lot of ideas in this direction. I think it was way too early to explore that. But I think like, and I've always sort of held that I think supply chain is kind of like it was never going to work in practice. But this particular way of going about it might be a big enough incentive for people to do it, where like maybe it's not about coming up with crazy ways of like releasing the value of your inventory. Maybe it's just getting all the participants in a given economic structure onto the same stablecoin. Like that might be the driver, because that makes that one company that does it like potentially so much money. Like there's, if you imagine dollar value wise, there's hundreds of systems where the dollar value kind of that's just sitting on bank accounts within kind of that structure exceeds the market caps of the biggest stable coins now.
Yeah. It's I'm sure this must have happened in other places in the world, but the historical example that I have very much in mind is in Latin America, where you had like large farms, plantations that basically, for intents and purposes, controlled or were the main part of an economy in a certain region. They all too often tended to pay their workers and sometimes their suppliers in kind of like their own tokens, for intents and purposes. I mean, I remember like they issued their own like currency, their own coins. And obviously this isn't scalable for a more global, I mean, and I'm talking like 600 years ago, right? I'm talking 19th century, maybe late 18th century. This is obviously not scalable for a global environment, but in a situation where you do have easy transfer between borders, and when you do have a common unit of the nation, like whatever it is, the digital dollar, digital euro, it's interesting that we might end up seeing that what you're describing is basically that exact same approach, just on crypto rails. And I just found that funny that we may have ended up end up finding out that the current version of banks was basically a hack to make things work. When we went back to the approach that the people were using before, only this time on proper technological rails. Anyway, just random thought to throw out there.
Yeah, I mean, I think there is kind of like a pendulum swing. It's sort of like between like institutional driven top down stuff to more like collectively organized things and so on. And like blockchains do just make it so much easier to do collectively organized things. Of course, you have regulatory hurdles, but like anyway. Let's see how that shapes up. I think if Ripple buys USDC, it's fucked. And that's great for me, and maybe not many other people. I don't know. But I think it'll be Coinbase. Like it has to be Coinbase. But one thing.
Okay, sorry. Before we jump off, like, why would Coinbase buy USDC, given that Coinbase is already getting most of the value out of USDC? Because one of the big issues that people kept going on with this IPO was the fact that basically Circle is giving up a whole bunch of its premiums to Coinbase. So they're kind of like getting the milk and half the steaks for free. Why the hell are they going to buy the cow?
Maybe the strategy is just to have a different business development strategy just overall for the future growth of the asset. So they think if they have full control over it, they can do stuff. I think that's a reasonable thing to pay for here as well.
It depends a lot on what the deal with Coinbase actually is, and whether like if there's flexibility to change that at some point in time, then they want to make moves kind of before that deal is up. And if Circle were to change hands, then that's maybe not good. So it's like a defensive play potentially, but I don't know what their contracts are like. But anyway, let's see. So let's talk about Ethereum. We've obviously not been super excited about the prospects for Ethereum. But just to take a slightly different angle on this, this was highlighted to me by the research team at Equilibrium. Ethereum is like far and away right now the biggest platform for real world assets. And the growth of real world assets. So there's a website people can go check if they want. It's basically RWA, like real world asset.xyz. And they have all kinds of dashboards. And if you go into the networks, like there's a menu, you go into networks, there's like a comparison between different networks. And if you look at that comparison, it looks like Ethereum's real world assets are going exponential. Then interestingly, and we can discuss this, number 2 is ZK Sync Era, which I was not expecting, honestly. And like I was expecting all these to go to Base, but Base is actually really small here. But this is, I think, assets issued, so we can discuss that in a sec. But basically everything else is growing, but the rate is very different than Ethereum. Ethereum is literally like hockey sticking, and everything else is kind of like growing marginally. And so the argument that was put forth to me was like, ultimately, when institutions like want to issue real world assets, Ethereum is just the most trustworthy, like reliable place. And so they end up deploying them on Ethereum anyway. And that seems to be happening based on the data. The counter argument I made, just to set the table, is basically like, I understand that. Like, I would probably agree that like it's the sort of safest place, but ultimately all of the actual trading of those, all the usage in DeFi is going to go to L2s, which then will not lead to direct value generation for Ethereum. So being being critical and being valuable are kind of two different things. But I'll stop there and just get your take, because I do think the chart is fairly convincing. It's like, I don't know, like I've been fairly skeptical of real world assets, but that chart there's a lot of momentum.
Can you say the URL again?
It's a bullish chart for what?
It's a bullish chart for the ecosystem, like overall, like for crypto. Like this is like a very, very nice chart. It's a very good data site, actually, rwa.xyz. People should check out the kind of other stuff that they have there as well. Shout out. I remember them from the early maker days when they were starting up the site. But yeah, there's some different takes on it. I think one is that it does cement Ethereum's importance in the ecosystem, in the sense that Lindy is important quite clearly, and just the fact that, okay, hey, where are we going to issue these assets? The number one name that comes to mind is Ethereum, and that has staying power that if Ethereum does things correctly, they can leverage to themselves as well over time. Like with the right plan, like that's an amazing kind of moat to have. And the way a lot of these assets are used is essentially just sitting in accounts. So the kind of Ethereum weaknesses are around that particular quote unquote activity isn't like, it's not a negative in some sense, at least. So there's no reason why that number can't climb a lot higher. But yeah, I think you are correct that then the activity kind of moves around it. I think the bigger point to understand about this, that it's the network effects around these systems are incredibly strong. It's the kind of thing that we've talked about in terms of price, where flippenings never happen. And the kind of like, yeah, and unless you actually, if like, let's say Ethereum did like 20% of Solana's throughput and was only 4 times more expensive, it would be incredibly difficult for Solana to take off, or Sui or whatever. Like there's just the technical gains that you have to make to actually quote unquote supplant someone, and even in this case, like no one is competitive in any way to Ethereum yet, at least. That speaks to something that you should understand about like the network effects around these systems. So yeah, I mean, it's a bullish chart for the ecosystem, and it can be a very, very bullish chart for Ethereum if leveraged correctly.
Yeah, no, not a lot to add there. I think and credit what credit is due. I think, I mean, I'm sure people memorize our calls religiously, but it was a couple episodes back that Mika had pointed out that if there was a next bump for Ethereum, it would likely come from people getting excited about real world assets coming on the chain. Lindy on a Lindy, so this is not that surprising. I'm still remain skeptical about if this assets being held on Ethereum as a chain means that Ethereum itself is going to capture any value for it. Right, as you mentioned, this may perfectly lead to the trading being happening elsewhere, and that elsewhere capturing all the value instead of the main chain, like it has been happening with like it happened with the explosion of L2s, right?
And it's not just L2s in this case. It's like Athena owns a lot of the BlackRock builds. So Athena is kind of controlling the customer relationship and controlling the management of the assets in that case. And they are launching their own chain. They have no loyalty towards Ethereum whatsoever. So they, like that, on paper it sits on an Ethereum account, but Athena owns that account and it's theirs already.
But there is some value in just the assets living on Ethereum, like that. Like there's that sort of friction to, like, you don't just move it all somewhere else. Like you could look at some analogies of projects that have kind of like migrated away from something, like maybe DYDX might be an example, and you lose people on the way, and so like that, like I do think that there's like the monetization of it is like is tricky if all the actual trading volume ends up on Unichain or Base or ZK Sync Era or wherever. But at the same time, like being the repository of the world's assets, like that does have some like inherent, like there's an argument to be made that like, yes, critical doesn't mean valuable, but it means that it's like there is value in it. Like if you cannot be replaced, then you must have some value, kind of thing.
And it
like
means
it's sort
there's
of
a
like a defensive
path
position.
there's a path to winning, in the sense that the most difficult thing is just to get going, and you've gotten going. So it means that there is like there is a way for you, if done strategically right, to kind of, I don't know what exactly that means, you know, like the cheap things to say is like improving the execution layer and stuff like that, but like you clearly you have valuable, it's like what are good businesses, like a lot of volume goes through you, or like you have assets under management. You have assets under management here, so there is value to be captured there.
Yeah, look, I agree with you guys. This has value. It is, as Mika said, it is definitely positive for the crypto ecosystem. It is something now where I would agree that it is valuable, but it is valuable in the sense that it may bring a certain type of application or trader or institution into the Ethereum ecosystem instead of going elsewhere. So it is valuable in those ways. But again, if that is going to add value to Ethereum itself, is what I'm not entirely clear on. Like this doesn't move my perspective of Ethereum as a main chain as much as it does the possibility of this. It's kind of okay. It has value in the sense that I don't think these assets are just going to jump to Solana tomorrow, right? But again, I don't necessarily think that this is going to create any significant impact on Ethereum. Is going to change most of the issues on that I see with Ethereum as a platform right now do not yet. They stem from the technical limitations and the issues that those cause, but those seem to be mostly downstream of incentive problems and of basically social issues on the way that the platform has developed, right? Until those change, I don't see Ethereum's value capture changing significantly. Ethereum, the platform itself. Again,
Yeah.
Ethereum, the ecosystem, sure. Not curious of how this is going to bring more people. The platform itself, I remain doubtful.
We've talked about this before, but there's value in kind of operating like a business, in the sense that there's like these L2 designs where, oh yeah, we stake the USDC or the ETH on the bridge as collateral, which means that we have a yield source, which is effectively we're monetizing the AUM, which Ethereum can't do, and perhaps shouldn't, of course, but like those things, they're so natural to make money off of.
Wait. If you stake assets in a bridge, you're doing those things on Ethereum L1, which Ethereum
but the monetization,
from.
yes, the monetization is that the L2 is swapping the ETH into ST ETH and then managing withdrawals back in ETH as need be. So they're the ones.
But it's still driving. My point is that it is still driving, transactions. It's still driving trade volume. It's driving liquidity, all on L1, which is like quite directly tied to value capture. It's maybe like less than, it's not maximal, but it is something. Like if all the bridge assets, kind of like if operations, if the projects running those bridges use that to monetize, they're by default doing that on L1, and then that kind of props up the Ethereum financial ecosystem on L1 to be able to sort of support that whole thing, which leads to like better liquidity than in many other places, because these are huge amounts of assets, right? Like
yes,
and in the future potentially much larger. And so there is like this, it feels like it's very similar to like Ethereum's whole strategy that it's been, is like, we're not going to try to capture all the value, we're going to try to capture some. And really the question is like, is that sum large enough to justify like, you know, the valuation and investors' expectations?
Exactly. It's like, okay, like what's the yield that this thing generates per year, and then the market will kind of find that price. But these are definitely like positive things for that yield, and it shouldn't be underestimated, even if you lose very important parts of the kind of supply chain in a way, just how much money you can make by offering very important services, like within the ecosystem, kind of
Yeah.
on a 20-year time horizon. Like, you can print a lot of money. Of course, the valuation of the business is quite high if you think about like other businesses in the world and their role in the world and things like that. So then it's an argument. Like there's plenty of arguments to be had there, about like who owns the customer relationship, how much does the money get funneled there versus like other choices, stuff like that. But it is a huge cash cow potentially in the future.
Yeah. I mean, I think one way to look at it is that real world assets as like a category beyond just stable coins, but everything, is potentially the largest market in the universe. Like, it sounds stupid to say, but it is potentially all assets. Like, it is potentially the market, that like the whole thing. And so like, while I'm not, I agree with Ricardo on like the technical limitations, and I think Ethereum will continue to run into these issues. Like, we're in the early innings of this. We'll just continue to run into the issues of all this being a little bit more difficult. And at the same time, you'll have the Solanas and stuff kind of becoming more robust and more getting more Lindy and whatever. We'll see how things play out. But one thing that this did kind of change for me is like, I think this is an investable narrative. I don't think I will invest on this narrative, but I think it's an investable narrative. Like, there is a path to a 10x with this narrative, which I think was badly missing from the Ethereum kind of general conversation for quite a long time.
I'll say that the key point here to make, which kind of ties maybe yours and Ricardo's points together, is that I don't think Ethereum necessarily did that much right to get this, apart from the stuff that they did right very early on and that paying kind of dividends. I don't think there's anything that you can point to the last 5 years or so which specifically makes this happen. I think it's actually the stuff that happened before, in some sense, which put its position in the market, and put it as the number 2 chain behind Bitcoin. That kind of made.
I mean, I hate to say it, but like, you know, like what they have done right, and the reason, like, it has just been smooth sailing in terms of upgrades, right? Like that is a thing.
Yeah.
It is very,
yes. Like, it's kind of like, you know, my argument on the flip side of that is always like if you're pushing the boundaries of what's possible, like you will break stuff, and you need to break stuff to learn. Ethereum is much more conservative, but for this specific thing, like in terms of getting kind of institutional trust, I think like that does help quite a lot.
That is
but
absolutely
again,
fair.
over time, you know, these things change.
And again, for me, it's not the main issue. Just to be clear, my main complaint is not, Ethereum is almost the same Ethereum that it was, however time frame you wanna pick for whatever value of the same, or Ethereum is not moving quickly enough because you don't expect a larger, a chain that secures so much value to move at the speed of a smaller, move fast and break things kind of things. For me, the main thing that I do not see a clear path to fix yet are the perverse incentives in the ecosystem that we have been discussing in the past. And those are the ones that I think if anything ends up sinking Ethereum as a potential platform, it is that sort of like the ecosystem being at odds with itself situation. Maybe this kind of clear vision gets everybody pulling in the same direction, but that is what I would expect. That is what I would expect to see before I get more optimistic myself about the platform.
Well, one thing to discuss quickly before we move on is like, why is ZK Sync Era number 2? Now, one caveat, at least based on the RWA.xyz metrics, they have 68 real world asset holders, which is not a lot as compared to the much smaller players like Polygon is 2.8% of real world assets, but it has more than 1,000 holders. Solana is 2.8% of real world assets, but it has 7,000 something holders. And then ZK Sync Era has 18% or 18.3% of real world asset market share with 68 holders. Like, that's kind of strange. Most of it seemed to be from something called Tradable, which I've never heard of, but apparently is some kind of private credit product. But that makes up like 2 billion of value for that. So that's kind of a fascinating thing, because like realistically, I would not assume ZK Sync Era would be up there. Like, I would assume Base would be higher.
Why is Stellar in there? What is the Stellar? I anytime Stellar comes up, I raise an eyebrow. Like, what the hell?
I mean,
is it stable coins? Because I knew someone who was actually building like a cross-payment thing.
It's excluding stable coins, the ranking. Stellar apparently has 461 million worth of real world assets, excluding stablecoins. And it is made up by mostly Franklin Templeton Benji Investments, whatever that is.
For every chain except Ethereum right now, in practice, one weird outcome actually like kind of moves it a lot. So the right analysis is kind of the right analysis to look at market share change, because those individual jumps probably don't like actually give you a great trend line post that kind of initial thing. And then it's kind of just looking at the breadth of the products and like having a qualitative feel around the quality of the product itself, and like how is this a real scalable kind of thing, and who's pushing it, and what are the reasons. But everyone else is so in this is like child's play so far for everyone else. So it doesn't really count. So it kind of you do have to take a time here to see what happens next.
Yeah, I mean, Ethereum has a lot more diversity in the assets that are included in that number. One thing to be said, though, is that BUIDL is like a massive amount of that.
Yeah.
BUIDL is like, I'm just guesstimating from the chart. Or actually, I can click on that. No, I can't click on the percentage. I'm trying. No. But I don't know. Guesstimating is probably like 30%.
Oh man, this is so sad. Like,
but the overall chart, I think, is worth still one more time highlighting. It is a very, very nice chart for this industry.
Yes.
Like, it is like the kind of, oh hey, stable coin volumes up only. This is very important, and in the same class of importance to me.
And generally speaking, I mean, this might be good for some bias check for people, because I'm terribly confused about Stellar and Algorand being the top 5. And if you had told me to pick, like, I don't know, 5 least likely chains that I would expect to see there, Stellar and Algorand would be in those 2. It's strange.
I think it's because these L1s and L2s that are very large in some market cap sense are able to push something through which gets like initial pilot going in a way on these chains, and that initial pilot already in the current numbers looks impressive. But then it's a plateau thing very much, and what drives growth actually. How much is it tied to, like in Solana's case, it's honestly like tied to usage, but in like some of these L2s, and it depends on how you structure the product as well, and like the way you move it and stuff like that. That it depends very much on what the numbers actually say. So there's a lot of nuance in this.
I mean, one takeaway here from this potentially is that like Stellar, Algorand, Polygon, Avalanche. Polygon has like an asset count that's almost the same as Ethereum. Monetary wise, not there, but almost. Like this is something you can do with business development, is I think like kind of the thing, right? Like if you do a good job of pulling in the projects, like you can do this with pure BD, because oftentimes these products don't necessarily rely on the users of the blockchain itself. It's kind of like external users, and that allows you to potentially like get in on this if you just do a good job there. Like they probably don't have the same natural pull as Ethereum, but they can force it to some extent.
This is a different mechanic, but it reminds me of post DeFi summer, getting a lending protocol that's kind of either new or forked off of something else on another chain, and getting like quite high relative TVL on it thanks to incentives. This has a similar kind of feel to the early market structure there, and then the development I think will kind of follow what we saw in the DeFi market, kind of similarly.
Yeah, I mean, one question to ask here is like I think maybe to turn this around a little bit is like why is Solana not higher? And then also like kind of in that direction, thinking about sort of similarly positioned chains, like why is Sui non-existent? Like that feels like a strategic decision that those have necessary. The fact that Sui has 17 million in RWA assets means they just have not prioritized them at all, because they could get more, right? Like that's not like a and I think maybe the same kind of applies to Solana to some extent, and I wonder why they sort of like haven't prioritized that more.
Yeah, I think it's one aspect is kind of like these are a lot of like credit fund type of things, which doesn't fit Solana's like decentralized NASDAQ idea. But if you look at what they've published recently, like they've pumped Remora markets and Leshner's new project, Superstate funds. That's a big deal that they're bringing tokenized stocks onto Solana. So they kind of similarly actually to DeFi overall, they haven't really done the high TVL stuff in a sense and done a push to that. And they're actually like targeting more naturally low TVL use cases, which is valuable. But I would also say there's value in the other direction as well. And Sui, I don't really know. Like tomorrow, there could be a 400 mil BlackRock build fund with like Sui incentives coming in or something that I'm trading on the fork of Sol, and like it could happen. So I don't really know about that, but because the absolute numbers are ones that each of these can force it to if they really want to. I don't know. It does seem strategic from that perspective.
There's the issue of I think it was on the last or second to last episode where we discussed having a North Star and having a very clear reason to exist. And those things are great because they do help make sure that the platform is really good for a particular thing, but the narratives can also blind you, right? Yeah, having a North Star can make you miss things. And in Solana's case, the fact that a lot of the, let's leave aside what most teams end up focusing on. I think that in the last 18 months, for maybe longer, 24 months or thereabouts, I have met exactly one team that was working on real world assets, and it wasn't like on a very particular like large institution focused way. So it just doesn't seem to be something that has been on the that has been on the community's radar, generally speaking. It might just be I'm not talking to the right people. This is obviously anecdotal evidence, but clearly also the fact that some of these may just be assets that are brought into the platform and then nobody does anything with them probably has an impact on their staying power, right? They're just issued and not moved. For instance, on the case of Algorand, on Algorand, it seems like the value of real world assets is between 7 and 10 times the amount locked in DeFi. In the case of Stellar, it's about 10 times. Whereas I think that in Solana, there's a lot more correlation between the actual users and the value that ends up being stored or moved in the platform. So it might just basically be a difference of how this thing is sold and perceived, generally speaking. I don't know. This is me shooting from the hip. I really hadn't had time to process this, but it's pretty interesting.
All right. Should we call it there, or should we discuss the accumulators as a last hurrah?
I mean, we can discuss the accumulators. It might come across as investment advice, which we probably shouldn't do. So maybe.
Yes.
No.
I have a take here because I gave the kind of big picture, I think, early on as a spoiler in this episode about the kind of how it looks like this is how leverage happens and exuberance happens.
Can you quickly explain what the accumulators are, just in case people don't?
Yeah, so we're referring to companies like Michael Saylor's strategy, which is accumulating BTC, but then we've seen an increasing number of them. So Jack Mallers, Tether, SoftBank is one group. There's a bunch of them on BTC. You've seen a couple of on Ethereum, and then Solana has a few like notable names. And essentially, they're all running a similar-ish playbook where they use financial instruments at their hand to accumulate a particular crypto asset on their balance sheet. Is that a fair description?
Yeah, I think so. I mean, it's like basically what they're aiming to do, all of them to some extent, is to increase. There's some asset that they want to accumulate. They want to increase the amount of that asset per share over time by sort of like any means necessary.
And
yes,
and
I
quick question
want to
before
jump into the any means necessary part.
Quick question there on what you're seeing in accumulators. Are you seeing mostly companies that are looking to focus on a thing, like MicroStrategy thing seems to be Bitcoin, and somebody else's thing is Solana, or are you seeing more companies turning themselves into an ETF of a basket?
No,
so far extremely.
Yeah, all single asset right now, and there's like just to like before we really dive into these, like I think this is like an interesting market structure thing where you have a exchange listed company whose only purpose is to be kind of like the optimal way to hold a single asset, and that like I don't like it kind of feels like the type of thing that happens when you have an old system and it doesn't quite like fit with the new system, so you just plug in like the new system into like it kind of fits like or it kind of seems like early internet people were like, what can we do with it? Well, we can put the yellow pages on the internet, like that sort of thing. But it is happening, and one thing that I really kind of like about it is that it makes for like the one line pitch of what this stock is, and like these stocks are available to a very large amount of people across the world, like incredibly clear, like so it's like the Make America Great Again of like pitching a exchange listed company.
But it also works actually kind of in some sense for a sophisticated financial actor as well, which is that they make the argument that this is the cheapest way to accumulate this particular asset. There's some like fun stuff you can do around the edges, but if you're just thinking about the core product itself, you can kind of pitch that, and you can actually pitch that quite reasonably. So what should these things be valued at is a good question. You can think of it as like right now they're valued at a lot of them, like let's say simple, you have $100 in Bitcoin, the company value is 200. And why is that the question? And the kind of argument that you can make is that it's a bet on their future ability to accumulate more of the asset. You get it if you do that long enough, you get into a bit of a circular logic, but it's not a stupid thing to kind of say.
And like one take I had on it is that like basically so what these companies do is they often use like debt financing. You could even do like issue new equity to raise more money, buy more of the asset, and you just keep doing this as long as people are valuing your company higher than the asset. So there is a circular logic, but it's sort of like based on collective belief, and it works as long as there is collective belief. What the argument I made was like basically what people are paying. Like if I buy one of these assets on the stock exchange, I'm paying for access to like institutional capital markets, right? Like I cannot get debt in the way that these companies can get debt. I can't issue shares to buy more Solana, and like I can't issue demo shares at 2 times my underlying holdings in order to buy more whatever. And so like there's this sort of access perspective, and then there's this circular thing, which I think is like fascinating, because like the way the capital markets work is that like if your share is valued higher, you can get more debt. So it doesn't matter why it's valued higher, you can still get more debt. And then if the debt is structured in a reasonable way, you can make the downside like very reasonable, right? So like for any of these accumulators, like I think betting that the assets they hold will be higher in the next year would be hugely irresponsible. But everyone in crypto, like who's long, is basically taking the bet that like in a period of let's say 10 years or something like that, like we'll be up. And so like if you structure the debt in a reasonable way, you can find like a nice middle ground where you're basically getting to just like leverage the shit out of your investment now while having a downside that is sort of like structurally very different from what an individual could get, right? Like if I go to the bank, they'll be like, well, you need to pay me back some of this like tomorrow kind of thing. And so I think that's kind of where it comes from. But I think the core question that Mika was pointing out was like, it's very unclear what they should be valued at. And there's also a further question, which is like, because they benefit so much from speculation, does that actually fuel more speculation? And so should we be expecting the multiples against their underlying to like basically continue growing as people realize that the more they speculate, the better it works, if that makes sense?
And I wonder if this is a classic case of the returns are going to be so good. Sorry, this is not invested watch. The returns are going to be so good that then we go through this classic situation that we've seen in this market, which is, well, there's a lot of demand for ICOs, so we oversupply the market with that, and that is the eventual kind of death of this, and that's maybe a signal to kind of look out for. And there's maybe too niche.
Mika, I think 100% now, like the thing that next blows up crypto in a big way is these accumulators. Like there's no doubt. Fuck AI bots. Like no, it's these guys. They will become so popular and so over leveraged that like someone is going to take it too far. It's the same as when we had all the, what's that company, 3 Arrows Capital, like like there will be a mania around them, and then that will just like spiral out of control. Some people will basically like everyone needs to constantly juice their yields in order to stay competitive, and that kind of like just, like everyone gets over levered, and then it just goes bang. Like that's what's going to happen.
I believe I have to use
wait.
again in sentence, apologize as not investment advice, but I'll say these instruments are surprisingly well downside protected, which is that because they are
the ones right now. But I'm saying like as people figure out that they can make thousands of % return on these things, the market is going to get very competitive, and people are going to get much looser with like risk controls, and that will eventually lead to a blow up. I don't think we're anywhere near that right now, but like that's 100% gonna happen.
No, okay, sorry. As there's there, I'm not actually even. Okay. Assuming that is true, it might actually be worse than the Three Arrows thing, because
it's going to be way worse.
Yeah, no, it's not just on scale, on spread, because up to a point, the companies that were lending to Three Arrows Capital were by and large crypto lenders. So it was kind of like crypto contagion. Like somebody had given this sort of company Bitcoin, and they shouldn't have lent it to Three Arrows Capital, but they were doing it. I think that most of the people buying the debt instruments for companies like MicroStrategy are not debt, not crypto companies. So this blows up, it is going to blow up whatever TradFi businesses are giving them money.
Yeah,
nice.
Which makes sense.
Crypto is now a systemic risk to the traditional financial system.
Yeah, we can kind of be very proud of ourselves, and it's kind of a natural next step into the world economy.
Mika's take is like we can be proud of ourselves, and now we can Ponzify the whole economy instead of just the crypto economy.
I've been in
we have got to close on that one, man.
We're perfectly capable of taking down the world economy. I don't think we need to be too pessimistic about kind of the ability of this industry to generate ideas which are completely destructive. But maybe one nuance thing I want to add here, which is interesting and may kind of, there's an argument here that you shouldn't lower Solana inflation. And the argument here is kind of that these Solana companies, they like Sol Strategies actually doesn't say they're just an accumulation company. They're like, oh, we're a technology company and we do validator stuff and yada yada.
Blah,
and
blah, 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 blah.
Yeah. I'm going to get to the point. They have revenue, and they make a lot of money and they make a lot of money essentially on like very, very low fixed costs or operating costs for the business. And they make that money in a nominal fashion in practice and not real, because if you're making, let's say, 7% on Solana, how much of that is real yield and how much is nominal? Nominal dominates at this time. However, on the balance sheet of that book, it looks as if it's real. So, and whether or not you convert it or not, it doesn't matter. It looks real. So you can value that at a high. Then and it's a growth stock, yada yada. It's going well, so you put like a very high valuation multiple on that, and you kind of get like an extra benefit from this. I do wonder. But maybe I'll make the prediction, which is that the Solana ones work kind of even better in this than MicroStrategy, because you're actually pricing this in a way which is like, oh, this thing is making 8% per year profit on this in addition to that. So then we'll put like a 30x valuation on that 8%, and then we're in a very exciting territory, I would say, with that kind of structure. So if this gets crazy, maybe that plays actually a bigger role than people are expecting, even though it sounds kind of niche here.
Yeah. Bitcoin doesn't have opportunities to do many of the things that these guys can do, right? Like that's the big difference. There is an element of which the fact that you can't do more exotic things is also sort of safer. But I just want to paint this picture. So I think these things will become the norm. I think they will exist for all major networks. and I think like ultimately it's just going to keep getting pushed. Like I think the structure will work like so well for a time that you just have this like baseline buyer for all networks constantly, and the impact of that is what I was describing at the end, right? The thing is, before the end, what this will do is eat up all the sort of like sell side pressure from these networks, and not investment advice, but I think this is going to be a big reason why like prices go through the roof at some point. I don't know when. Like this is still very early stages for many of these companies. The only one that's been doing it for a long time is MicroStrategy, and MicroStrategy in the context of Bitcoin like isn't moving the needle nearly as much as these other ones might. But that's why I think people are going to jump on it so heavily, because if you're like trading in like the, let's say 10 billion, you're like a hyper liquid. Having a company doing this like has a huge impact on your market value. You can 100x kind of thing potentially. And so I think that people will move like far out on the risk curve, and this will start to happen all over the place. And that like it will be a bubble 100%. I would be very careful in how to go about it. There's all kinds of other reasons that might cause them to blow up. You could just have a general like, I don't know, macro recession that blows all these guys up because they've structured their debt like not conservatively enough. But I do think this is kind of like the big one. This is crypto sucking capital from TradFi and just like pumping the shit out of everything.
Maybe a good place to say not investment advice once again. Just to...
one more time. Not investment.
I'll just put that right there. I wanted to put it after you said 100x, but I'll put it here at the end.
No, I'm saying like for a small network, like, you know, the impact, like it all depends, right? Because it's also like if you're a small network and you have an accumulator for that network, how much ability does that company have to gain recognition? Because it is a very speculation based play. Like you need to be noticed. The thing that my strategy has is like everybody knows strategy, right? They're able to collect any amount of data they want due to that. And I think in the Bitcoin world, only very, very visible, prominent players can kind of compete with that, which is why you get the Tether, the Cantor, the SoftBank, whatever the shit. Because like you just like it's too big. But for smaller networks, you can start smaller. And I mean, you see this now with the Solana things. I've been asking for a while, like, where's the XRP equivalent? I would think Ripple would be all over this. But I mean, I think again, not return, but increase in market value from this becoming like a systematic industry-wide practice can be bonkers. But that also means that the crash, when it happens, is going to be super bad. Like, yeah, like, you know, small countries going bankrupt, bad.
One interesting aspect to that, I think, is also that this is one of those, like, if Solana survived the last cycle in somehow intact, it's going to have a huge run. It's the same for this product then in, I don't know what the timeline is, let's say 2029, which is that if you structure these products correctly, you actually quite efficiently could maybe possibly be accumulating at the lows. This is what MicroStrategy did. If you look at the MicroStrategy performance from bottom this cycle versus BTC is like 6x or something, and MicroStrategy is like 32 or something around that. So
yeah.
So you're actually, if you manage to stay alive, if you manage to make it through the cycle, someone will also make an incredible trade kind of on the back end of this thing as well. So there's many ways to play this over the next year.
So yeah, exactly. So I think one important thing to highlight is just like with all crypto investing, like my personal strategy of buy low, sell high applies. And so like these things like are like, yeah, with as with any crypto asset, like buying these things in a bear market makes a lot more sense than in a bull market, right? And I wouldn't say we're in a bear market now, given that Bitcoin is at all-time highs. So that's definitely a thing. And also, like one thing that we don't really know yet, maybe there's some data from MicroStrategy, but I feel like the model was not that understood until relatively recently. But what it will be really interesting to observe is how these things trade in the bear market, sort of as in terms of multiples against their underlying. So like do multiples compress in the bear market, and to what degree? Like I would assume yes, because it's probably so speculation fueled, and when speculation goes away, then multiples go down, which then makes it sort of even more attractive. Like kind of like the closer the price is to the underlying, the better an entry it is. And then yeah, the other way around as well.
Yeah, the DeFi Dev Corp guy was on the Solana podcast, and he actually mentioned this not as an immediate plan, but just as conceptually that that it may be important to have like shareholder rights to redeem the underlying in case of like, because you want to avoid
if it's
getting
trading under
yes,
NAV.
Yeah. So if you get into because you can get into a grayscale hole here that does last forever. But if you're actually able to put in those protections in a reasonable manner, there's a couple of interesting ways to structure it that can even be beneficial to a company. But if you do that, you save yourself a lot of headache, and you can maybe like force a premium, or you don't almost even have to force a premium. You can just force par. And if you force par, there's probably like some things you can do to accumulate more and stuff like that. So yeah, there will be a difference in
redemptions
those.
against the underlying are kind of tricky, potentially, given or depending a little bit on how the debt is structured, though, right? Like
Yes.
like in theory, it would be great if you could just at any time pull whatever your shares worth of SOL is. But if everybody does that, then there's nothing to pay back the debt with, right?
There's some speculation on what the exact mechanics should be, but it's essentially like a penalty payment is somewhat what you would expect there to be in this type of structure. So you're paying a 7% penalty for something like that. And that kind of automatically rebalances it because it keeps like a trading range there also and stuff like that.
Yeah. Well, I think is super interesting. There was one project I saw that was, I don't know that it actually makes that much sense necessarily, but their plan was basically to create Bitcoin accumulators for all the different local markets. So instead of like, NASDAQ US, you have one company in, whatever, Finland, and it's trading on the local stock market. One company in Germany that's trading in the DAX, like blah, blah, blah. And in that way, like bring it closer to the people. What I don't really understand about that is if you're on a major stock exchange, basically all those local markets already have access. Yes, there's some fee stuff, and maybe there's some geopolitical worries, like, whatever, if like it's like not a crazy idea right now to assume that there's a non-zero chance of capital controls in the US in the next 20 years, and like blocking withdrawals. So like maybe something like that you can kind of protect against it, or something, like maybe there would be demand from that perspective. But I feel like it's a bit of a weird idea given ultimately how networked the traditional financial system is anyway.
However, if you're right now looking at Metaplanet is doing exceptionally well from Japan. So there is like a weird element of locality that happens.
No, this is why a different situation.
But like wait, there is an element to this. Like there is like this isn't a direct analogy, but like the reason regional crypto brokerages work is not because they're competitive. It's because like somehow people are just like, I don't know what, they want their local language. They want to know there's a post box somewhere in the same country, like weird shit like that. Like that market I think is much smaller than kind of like the big global market, but it does exist.
The main reason why I say that this is a different situation, it is because what you're describing, Teemu, this kind of like a fund spawning organism, seems to kill one of the reasons why people convince themselves that these things are going to be more valuable in the future, which is whatever narrative they're piggybacking on. Like one of the narratives that MicroStrategy was flogging at some point was basically that we're going to become a Bitcoin bank, and having a lot of Bitcoin is going to be our edge in that, right? If you have a focused company that, even if they're in a single country, if you have a focused company that is an accumulator and they can spin up their shares via narrative. Sorry, if you have a focused company, it's a lot more likely that they can spin up their shares via a narrative like that, of this is how we're going to use this in our business. I don't see that being something that fund manufacturer can do.
I don't think you need a narrative to be an accumulator. I think the MicroStrategy stuff is like, that's old news, sort of like because people didn't get it. Now all the accumulators, like the new ones, are just saying we're not trying to do anything else besides accumulate. So I don't kind of entirely disagree, and I'm not like super bullish on that model. I just think it's like an interesting alternative approach to try to get demand, right? Like because ultimately the thing that matters is your recognizability, your ability to get people to speculate on your stock, instead of competing with everyone else. Instead of competing with the tethers and the MicroStrategies, that's like a different play that maybe you can pull off to a reasonable degree because it's not that interesting for them because they're going after a bigger pie. Like, possible. But certainly I think this is one of the main like this is pure financial engineering, right? Like this has nothing to do with product market fit of any kind.
It's just perfect fit for
perfect fit for our industry. Yeah, right. Like this is, I mean, this is what a lot of the
this is what we all trained for, like on chain, in the trenches, DeFi summer onwards. Like this is what we've been practicing. You think we don't know how to run this? Well, we're gonna kill you guys. This is my message to the traditional markets. They're gonna die here. Like, this is
this is like when there was this Peter Thiel quote where it was like, he was talking to Elon when Elon was younger, and Elon said something like, all the aerospace companies are like fucking dinosaurs. They don't know what they're doing. If I ever get in there, it's going to be a bloodbath. This is like kind of like that. Like, there's a lot of expertise in TradFi and whatever, but wait till you get like all these insane crypto people in there fucking shit up. I don't know if this is good though. Like, I will say that. Like, I'm not sure. I don't think there's anything I can do to prevent this from happening, but I do not think this is necessarily a great thing for the world. One thing it will do, this is probably going to be the largest wealth transfer from the old people to the young people that has ever happened in history. Good or bad, we'll see.
There's this great saying, I don't remember who it was, but it was like every generation needs their own Ponzi. Spelunking.
We can trust you to come up with a Ponzi angle, Mika.
Yeah, it does feel a little bit like the early lending market days when everyone was like, making 3-figure yields. Like it was 3-figure percentage yields. And then weirdly that didn't work out forever. Strange. Anyway, we'll call it there. Once again, not investment advice. Hope you enjoyed. See you guys next time.